Matthew Bell with insuranceprescription.com. Today I want to talk about 3 hidden factors that can negatively impact your performance in the stock market. Now, these aren't going to be hidden to everybody. What I mean is that these topics are a little more arcane than what the novice introductory investor person just starting out, what they're going to be used to. And I should disclose, first of all, that I'm not an expert. I am not an economist. I'm not a financial advisor. So this video is for general informational or entertainment purposes only. I'm kind of an outsider looking in. But this situation in the country right now has brought certain things into relief for me, and I thought I would at least do a brief video trying to cover some of these just to bring them to your attention. Now, just as a background, just by happenstance, I came across an article in a British newspaper, and it was directed at women, but the article was written 1 year ago, and the title of it was "Why Women Need to Stop Saving Their Cash and Start Investing." The article is 1 year old, almost exactly. What occurred to me in running across it was, let's suppose somebody took the advice of the article. They took, let's say, $100,000, they put it into the stock market, and let's even suppose they got a 10% gain the first year. So now they're up to $110,000. Well, the 30%, let's just say, decline in the market that we're experiencing now would have ratcheted their initial investment back down to around $77,000. And obviously the article author didn't know that was going to happen, and nobody knows what the markets are going to do. And generally speaking, any kind of advice like this is given with all kinds of disclaimers, kind of like the one that I just gave. But the fact of the matter is that a lot of people look at that and they think, I'd be better off just putting my money somewhere else. And part of the reason isn't because they're doing the math with respect to the interest rates or the returns. It's because they just don't understand the market. Now, in response to that, you'll see a lot of material out there that's basically going to say, oh, you know what, it's nothing, there's nothing to it. For example, this article from thebalance.com titled "How to Make Money in Stocks," and they basically start off by saying that it's not really anything complicated, a couple of easy principles that you can follow, and they recommend buying and holding. They hold up Warren Buffett, as many of these articles do, and they basically just say, look, the trick is just to pick a good company, buy stock, and keep the stock. This advice is often bundled with the adage, time in the market is better than timing the market. Now, of course, market timing is basically where you try to be clever about when you buy or sell so that you beat the market or you do better than the index average. But if you're not so sophisticated, some people say, you know what, just put your money in an index fund, a fund that's set up to kind of give you a representative sampling of all of the different companies that are present in that index, and then your fortunes essentially rise or fall with the index. And if you don't understand what you're doing, even Warren Buffett says this is a good way of investing your money. Now, on the other hand, you could buy into a small company, but however you do it, the basic point is that you're putting money into a company and you're making money if they make money, and you're losing money if they lose money. So you share in their profits and you share in their losses, and you put your money into the market, and if you leave it in there long enough, you're bound to make some money. The problem, as I see it, isn't that that's wrong or that that's not appealing. It's that the actual market, the way that it operates, is so top-heavy with a bunch of arcane junk and add-ons that it's hard for a small investor to make heads or tails of it. So I'll give you 3 different examples of this. Example number 1. There are certain markets, like the derivatives exchange, that are so big and that are so complex or convoluted that the average investor can't hope to penetrate that market and almost can't even hope to understand what's going on. And yet, these markets, in virtue of their size, are large enough that they can pull the entire system down if trades go bad. So just to give you an example, I'm going to go to 2010 in something that was called the flash crash. Now, there have been other flash crashes, but this one in 2010, I'll read you briefly from an article that was published in the Guardian newspaper for Britain. It says, in just 20 minutes, the New York Stock Exchange had witnessed its biggest stock plunge in decades, all traced to one gargantuan sell order. In a matter of minutes, the Dow Jones Index lost almost 9% of its value in a sequence of events that quickly became known as flash crash. Hundreds of billions of dollars were wiped off the share prices of household name companies like Procter & Gamble and General Electric. The carnage took place at a speed never before witnessed, and here's the kicker, officials in the U.S. were blaming big bets by a trader on Chicago's derivatives exchange. Now, what is the derivatives exchange? Well, derivatives are essentially high-level bets. You can bet on the direction of a price. You could even bet on bets, so there are derivatives on derivatives. And it gets very complicated, very convoluted, and once again, the introductory investor is almost hopelessly lost in this. And yet, if you just Google what is the size of the derivatives market, Investopedia suggests that it could be on the order of $1 quadrillion with a Q. Now, the article has a little bit of subtlety to it if you read it, and they'll say, well, some people say that's not so big. The point is, if people don't even know how big the derivatives market is, how can the introductory investor hope to get his or her mind around that? Now, you might say, well, look, we're not looking to get into derivatives. That's not the point. The point that I'm making is the point that this article made. In a matter of minutes, the stock market crashed because of a trade that was placed in the derivatives market by a person who had deeper pockets probably than you or I have. Now, just pursuing this a little bit further, I have in another video, I get more in detail into this, but the negative oil prices. Negative oil prices show, in part, the effect that the derivatives market can have, because you would think that a commodity is not able to go negative in terms of its price, and yet, despite the fact that we're in an environment where there's a decreased demand for oil, to be sure. But take a look at this article. New York Times, U.S. oil prices plunge into negative territory, and here they say, prices went negative, meaning that anyone trying to sell a barrel would have to pay a buyer $30, in part because of the way oil is traded. And how is oil traded? Well, look at the Financial Times. What negative U.S. oil prices mean for the industry. And it says each month, futures contracts need to be settled with physical delivery of crude oil, giving a real-world link to one of the world's most heavily traded derivatives. So they seem to be saying that in most cases, these prices are generally fixed by the derivatives market, and then they're hooked on to reality in virtue of this thing called settlement with physical delivery. So it just went haywire in this case, is what they're trying to say. But the point is, this is all very high-level stuff, and it is an utter mystery to most people when they're just getting into investing. Finally here, negative oil prices put spotlight on investors from risk.net. Any attempt to disentangle physical oil markets from financial derivatives and analyze them independently remains largely wishful thinking. And here's my point, is some of these arcane topics do affect the market that you are trying to invest in. Even if you don't like it, even if you don't understand it, and even if you try to ignore it, the fact of the matter is these high-level bets in these very ballooned, very oversized markets can have a negative impact on the money that you put into your 401k. Now, a second reason that I'll give is market manipulations, mathematical manipulations. And here I'm going to turn to an article that I've mentioned in other places, and I'll put the screenshot up, I'll put a link in the description. But essentially this is something called a share buyback or a stock buyback. I'm going to turn to an article from CBS News titled 3 Reasons for the Longest Bull Market Ever. And the reason that I want to look at now is reason number 2, share buybacks. And it says about share buybacks that it's when a company uses income or debt-fueled borrowing to buy back its own shares. And why would it do this? The answer is buybacks reduce the number of shares outstanding, thereby boosting earnings per share metrics. So in other words, it is a mathematical trick to reduce the number of shares outstanding and thereby increase the share price. So the cost per share goes up when the number of shares goes down. But companies that do this haven't produced anything, they haven't been innovating in any way, they're not stronger than they were before they did this buyback operation. In fact, they're probably less strong than they were before, because this trick essentially hollows out their balance sheet. That is to say, they spend their cash reserves. So a company needs cash reserves for a time like what we're seeing right now when maybe business goes down. They can draw from cash reserves. But if they spent their cash reserves buying their own stock back just to boost their share price and the bottom falls out, the market could really take a nosedive. And many high-level companies have done this. So Google spent $18 billion buying its own shares back. GE spent $40 billion buying its shares back. Boeing spent $43 billion, and Apple spent $67 billion buying its own shares back. Now, the third reason that I'm going to give is artificial intelligence. And this is perhaps the strangest one, but it's also, I think, one that's going to be increasingly relevant, because given the situation that we are in right now, the New York Stock Exchange just a few weeks ago announced that it was closing the trading floor. So there was no person-to-person trading at all. Everything was going to be done electronically. And in fact, probably even before they did that, the majority of the trades were already being conducted electronically. In order to understand this point, you got to realize that the internet is more and more populated not just by people sitting at computer screens, but by sensors, by computers running algorithms, and that these computers can talk to each other and are linked into each other in various ways. Now, to go back to the 2010 flash crash that I mentioned earlier in regard to the impact of the derivatives market, I want to revisit it again. Subsequent opinion has it that the crash was in part due to trading computers that were talking to each other and executing trades at such a fast rate of speed that the humans in charge of overseeing these computers couldn't catch the mistake or couldn't catch the activity until the market had crashed. Now it recovered, but I want to take a look at this from New Scientist in an article titled "Computer Traders Blamed for Wall Street Crash." We read, "When the Dow Jones Market Index suffered its largest ever single-day drop last week, fingers were soon pointing at the high-frequency traders and the computer programs they rely on. The Dow Jones Index, which follows 30 large publicly traded companies, plunged an unprecedented 6% in 20 minutes for no apparent reason. The reasons, in retrospect, for the plunge remain unclear, but high-frequency traders who use powerful computer algorithms are in the frame. The traders use computers to profit from short-lived fluctuations in the market, and an algorithm in one of these computers might make trades before the rest of the market has time to react." So they're trying essentially to have a computer pick up on very subtle changes and indicators in the market and then be able to react to that and execute these massive trades if need be, or very quick trades, in order to capitalize on this before anybody else knows what's happening. Now you can see that the transactions amounted to around 8 billion last year, and that was when the article was written, so that was in 2009, and heck, we're 11 years past. I don't know what capabilities they have now, but it says these near instantaneous trades make some economists nervous. They fear that algorithms could interact to create a feedback loop of continuous selling, driving market prices off a cliff. Why are they concerned? It's because the speeds are so fast. The speeds are shrinking, and the number of trades is going up. So you see 3 million trades per day in 2005, 22 million per day in 2009, and once again, no conception of where those trades are now. But there are no real-time safeguards, or at least there weren't when this article was written, and the people tasked with suspending markets in the event of dangerous trading would not be able to react quick enough. Just stepping back and reviewing. We're often told that getting into investing is super easy, and it can be when you are trying to just put a little bit of money into an index fund, but the point that I'm trying to make is that there are very high-level forces at work. So the derivatives market, possibly 1 quadrillion in terms of size, is affecting our lives in ways that we have trouble keeping up with. Number 2, the manipulations, I'm going to call them manipulations, that companies can go through in order to make their balance sheets look a little bit better, give us a false sense of security, can misrepresent the actual condition of the market. They can make us think that things are better than they really are. And number 3, when you plug in the fact that many times some of these trades are executed by computers basically set on autopilot, the market has crashed before because of it, and the market could crash again. There can be some strategies for helping you maybe swim in some calmer waters, particularly if you're new. I will get into those in some subsequent videos, but for the time being, if you found something of interest, found something curious, even if it's not happy information, I would ask that you like the video, that you click the subscribe button, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you.